TCS ticks lower after profit and margin miss estimates in the second quarter. Brokerages Jefferies, HSBC and JP Morgan remain bullish on the stock, while Nomura issues a neutral rating.
Oil exploration companies ONGC and HSE gain as crude oil prices gain overnight to nearly $80 per barrel.
Nifty metal is the top gaining sector on hopes of an aggressive stimulus in China. Gains are led by Nalco, NMDC and SAIL.
It's a double positive for Bandhan Bank. The stock surges after the bank gets RBI approval for the appointment of Padra Sengupta as the MD and CEO of the bank. The bank also receives claims of over 1,450 crore rupees for total dues of around 2,200 crore rupees from the NCGTC. The good news is there's unlikely to be further provisions post this settlement.
Cummins corrects in trade as Goldman Sachs downgrades the stock to a sell rating with a target price of 2,900 rupees a share, citing concerns over growth and margins.
Hello and welcome to Chartbusters. I'm Nigel. With me is Vivek today on a Friday. Vivek, well, it's as quiet as can be, right? The Nifty is more or less holding its ground. We are flattish. The good news is portfolios are feeling good because the mid-cap index is doing better and the Nifty bank is stabilizing. But yesterday it had a bit of a breakout day. So you'll want it to build on from here on. And the Nifty IT index, one would have said TCS numbers were disappointing. Parts of the commentary were disappointing as well. But the dip has got bought into. The tech index is in the green, telling you the kind of frame of mind that the street is in. You have the tech index that's sitting with a gain of around 0.3%, and maybe that bit of a whisper that we heard yesterday that the numbers could be disappointing, that helped in pre-positioning, which in the end gives rise to some short covering.
Good morning, Nigel. You're absolutely right. In fact, despite the fact that quite a few EPS downgrades as far as TCS is concerned, the Nifty Tech Index actually managed to pull back. Yesterday, like you mentioned, the Bank Nifty did very well. In fact, names like Kotak Mahindra Bank were amongst the top gainers yesterday. The Bank Nifty seems to have cooled off a little bit, especially after yesterday's very strong rally. So it'll be important to see how that particular index does going forward. In terms of individual stocks and individual sectors, keep an eye out on the pharma space. Yesterday, you saw significant price correction as far as some of the pharma names were concerned. So look at names like Lupin, Cipla, Dr. Reddy. All of these stocks actually saw quite a bit of fall yesterday. Today, they seem to have come back quite strongly. There have been quite a few notes coming in terms of some clarification regarding the news flow yesterday.
Well, that's right. Let's focus on a couple of stocks then. We have Feroz who joins us to help us detail Anand Rathi Wealth numbers. Hi, Feroz. Good morning and good to see you as always. Feroz, the numbers look quite good. The guidance you've laid out, well, you've smacked it in the first half of the year itself. So you put out a revised guidance. Give us a few details. What were the primary as well as the secondary issuances of structured products in this quarter? And also, if you could tell us, have the spreads moved?
Yes, Nigel. Firstly, yes, we've revised our guidance from 280 crores to 295 crores for PAT, and we've increased our guidance of the AUM number from 7,200. 72,000 is what we had said, but we are already at 75,000, so we have revised that AUM number to 80,000, and the revenue numbers have moved up from 910 to 980. That's our current guidance. Point one. Point two, I don't think we look at issuances on structured products so microscopically because these are all bottom-up numbers. If anyone is a shareholder, the way he has to look at it is these are portfolios created for 10,990 families. The culmination of the portfolio rebalancing and balancing activity results in whatever is my issuance. So we don't go what revenue I want to do and what structured product will I sell. I go bottom up because clients have earned money 20, 30, 40 years of hard-earned savings. So whatever is their return risk objective, that culminates to whatever is the allocation between the 3 products only which we do out of the 16 wealth management outfits can sell, which is debt mutual funds, equity mutual funds, and structured products. Now, if I have to give you some color in terms of the potential, ideally on April 1st, 2023, our structured product allocation as a percentage of the total assets was 29%. Now it has come down to 23, 24%, which implies that 5% realignment opportunity exists because of higher mark to market in the equities side. So 5% of 7,000 crores, 75,000 crores is the potential of structured product net sale over the next few months when we try and realign people's portfolio back to where it started from.
Firoz, thanks for that. So what you've essentially done at the end of H1 is that you've revised upwards your AUM guidance, your top line guidance, as well as PAT guidance. And we believe as far as the top line and PAT is concerned, you've already met close to 50% of your revised guidance that you have for the entire year. Now, number one, the main question here is net inflows, have actually gone and seen quite a bit of a dip on a sequential basis. Is this a one-off phenomenon according to you? And which asset class actually saw the dip? Is it on the back of the fact that there are actually a few open-ended schemes that were launched in the quarter gone by? Is it because of that? And how are inflows expected to pan out for the rest of FY25? What's the ground level feedback?
So firstly, the net, you're absolutely right. Sequentially, between the last quarter, same year, equity mutual funds have had a lesser net flow. See, what the problem is, since I'm not in the business of selling a product, I'm in this business of managing people's portfolios. So what happens is, if I have to realign money from equity mutual funds, structure products to equity mutual funds, the flows could be larger there. So I'm not just a provider wherever there is be at the right time at the right place is not the strategy of Anand Rathi Wealth. So what's going to happen is, if I tomorrow reallocate money from structure product to equity mutual funds to structure products, which is what realigning the portfolio is all about. When markets give you a lot of return, you'll have to realign. So you might see an outflow from equity mutual fund into structure product. That doesn't imply that my clients have stopped buying equity mutual funds. It's a realignment. Point one. Point two, 5,700 crores. We had an aspiration 5 years back. Our total net flow was just 400 crores for the full year. We had this aspiration of getting to 1,000 crores per month, which we are almost close to. Unfortunately, we have not got to 6,000. 6,000 is what we had an internal target of. We got to 5,700. Some God's help, some markets help, the positive sentiment. But what I think your viewers should notice, which I'm sure will get unnoticed, is how does Anand Rathi Wealth Limited perform in the bad sentiment of the market? The worst quarter from a market standpoint after we've got listed 12 quarters back was the first quarter of FY23, where Nifty fell 10%. That quarter, sequentially, we grew 33% year on year.
Interesting. You made this point before as well, Firoz. So, it appears you're reassuring your investors out there that even in a bad market, you can continue to outperform. We get that. Give us a few details then. What's the blended yield in the past quarter? How do you see this number pan out going ahead?
See, now if you have 75,000 crores, if we are looking at 980, the yield is 1.2, 1.3 on the current assets. Yields are on weighted average assets, and AUM is measured as a picture, and yield is measured as a movie. So 75,000 crore AUM is the 30th September number. So if you look at the yields which we make on the three products which we sell for the last 12 years, we have not launched anything new. And the same boring things HNI buy, unlike the popular belief that HNI needs more interesting, innovative products, which is not the case. He needs a better Sharpe ratio. That's what we try to deliver. So coming back to your point, if you look at the yield, long-term yield, you will get 1.2, 1.3. What we make on our mutual fund model portfolio is 1.09% post-GST. The yield of structure products calculated backwards at maturity is 1.17 for the 3,000 odd structure products which we have done, and out of which 1,500 have matured, which is one of the largest maturities of our sister company, which is Anand Rathi Global Finance. I don't think most of the NBFCs wouldn't have had that kind of maturities paid on time every single time.
Firoz, on the front foot today, smacking it out of the park. Firoz, I can feel the confidence in your tone as well. Since you spoke about the three categories, the breakup of your AUM, debt MF as a percentage of the total mix, that was 9%, has come down to around 6%. How do you see this number panning out?
There are two parts to it. We generally don't like to take assets. We try and keep a very strong bouncer at the gate itself. We don't bring short-term assets at all. If a person has intergenerational wealth, which is what most ultra HNIs and HNIs have, if somebody's got 20 crores, in the next 20 years, if he grew at 15%, 14%, he can have 150 crores. So he's not going to be, or she's not going to be able to spend it. So the reason why our debt proportions are small is because we believe that if the money is intergenerational, debt is almost like poison to the portfolio because it will not beat inflation. And this whole market timing of interest rates coming down, we don't buy that theory because the long end of the yield curve has not gone up. So if RBI reduces interest rates, it doesn't imply that the long end of the yield curve will also come down because it's not gone up. So yesterday 6.89 is the 10-year paper and 6.56 is the 3-month paper. This is the flattest yield curve India has ever seen, at least after I've started working in 2004. So I don't think this whole argument that debt will make huge capital gains if interest rates were reduced by RBI, because RBI tinkers with the short end of the yield curve. And so we are not bullish on any opportunity on the debt side either. And anyways, for long-term monies, debt will not be able to beat, especially given the post-tax returns, will not be able to beat inflation. And anybody who's got monies for the next 3 generations should not be wasting time in debt.
Firoz, another question, and slightly more from a regulatory point of view, and we want your view on that. There have been significant clampdowns as far as F&O trading is concerned, and there have also been a reduction in the number of expiries that each exchange is allowed to have. Do you see any second derivative impact, number one, on your business, number two, any impact on the structured products, and what is the kind of feedback that you're getting in, from customers, especially given the fact that they will now face fewer products to trade in terms of expiries?
Yes, thank you for that question, but you've opened a little larger canvas. So let me try and explain that. Point one, I think that's the best thing regulator could have done. Because just go in weekly expiries in India started in February 19. That's close to 5 years plus. Just a year back, we had very few expiries. Now, because of the exchanges wanting expiries on every day, a person could have quit his job and had with the same 4 lakh margin could have done 1, 2, 3. Monday ko ek kaam hai, usko Friday tak kaam hai, and weekend he chills. So he was gambling with his hard-earned monies, and it could have become a full-time job because every day he had an expiry, and the same amount could have been used 5 times in the same week. So expiries converging or elimination is the greatest thing. Most retail participants or most even HNI participants don't even understand option Greeks, let alone Black-Scholes pricing model. They don't know what's delta, gamma, vega, theta, rho. The second order derivative of is also something which a treasury guy will know, which is Vera and Veta. These 7 items, without knowing this, if somebody is trading, he's only speculating, and and institutions have done 3-year courses. My colleague who has been at IIT Cambridge, who has done a derivative course and then sits on the terminal, he will definitely have an advantage over 99% of the retail traders. So as a parent, a regulator has to protect the interest, and I think this will be very good. From a structure product, collateral damage or collateral benefit, I think it will have a huge collateral benefit because futures volumes don't get impacted.
Thank you so much, Firoz. Out of time, for this short interview, we'll get you once again to discuss this particular development in detail. Let's now slip into a short break. After the break, we have Sandeep Ghosh, the MD and CEO of Birla Corp, to discuss the cement sector outlook. Stay tuned.
As promised, let's turn the spotlight on the cement sector. The first half of the year was a bit of a washout. The street is optimistic. The second half will be far better. To discuss this and more, we have Mr. Sandeep Ghosh, the MD and CEO of Birla Corp. Hi, Mr. Ghosh. Thanks a lot for joining in. Well, tell us, how are you reading the situation? The fear is that the first half of the year was a washout. Are you seeing signs of recovery now on the demand front? And what about pricing? Pricing is at the lowest we've seen in 3 to 4 years at various pockets of the country. Will price increases come about now? Are you seeing that sort of acceptance?
See, contrary to some of my industry peers of very larger concerns, I am still, I would be very cautious in my projections for the second half. And, some of them, the kind of growth they're projecting for the annual, the whole year, if you were to see that, the kind of hockey stick effect you need to have in the second half, to me seems very, very, bullish. But at the same time, if you were to ask me this question last week and today, I am personally, I think my optimism levels have risen slightly, and I'll explain that to you. And it is not so much for industry factors, but it is a larger socio-political, environment situations. Because this month, as far as demand goes, it is a festive month. You're right now into the midst of the Dussehra, when a lot of North India is affected. By the time you finish, you'll come into close to Diwali, and then today in November you'll have Chhat, which is today. It affects cement construction activities across the country, because you have construction workers from North India today traveling all over India, and they tend to go home. And so I would be, cautious about immediate organic demand growth just now. That's my overall feel. See, whatever people talk about the market, until your organic demand picks up, any kind of wishful thinking on prices, etc., to me has to be taken with a load of salt. So you saw some amount of.
So Sandeep ji, if you could give us a few numbers, you're sounding far more realistic and far more cautious than most voices on the street. Maybe with good reason as well. You rather project when you have enough evidence on ground. But as per you, at current reckoning, what are the industry estimates for this year? What kind of a growth should we be looking at? And do you believe prices are bottomed out?
Prices may have bottomed out. That's correct. But in terms of how, I'll give you two scenarios: the optimistic scenario and a cautious scenario, or conservative scenario, as I'm saying. If it's a conservative scenario, I see the year ending between 5 to 7% industry growth. That is how I see the delta. Instead of being over, if today, assuming your GDP growth is how people are projecting, even if that comes through, I don't see this time the delta being positive. Delta, there would be minus a percentage or 1.5% over the GDP growth. Therefore, between 5 to 7 is what I think is a reasonable estimate for the year's growth. But if what people are talking about, if in the second half you see I've heard terms like pent-up demand, if pent-up demand releases, but that pent-up demand can release only in the individual home builder segment. And that too in the rural economy, because, crops would be nice, a good set of crop, but you've had unseasonal rains. Even now you're having rains in many parts of the country. But given all that, if there are good crops, good returns, you could be having a growth there. But the biggest dampener so far is the government spending on development expenditure. Mind you, make a distinction between infrastructure and development. By development, I mean monies to be released in the rural sector, whether it is in developmental schemes of state governments or state government and central government combined. But central government releases the funds only if the state government puts in their part of it. And that's where I think has been the biggest bottleneck so far. So if those monies come forward, if people start releasing that, instead of diverting it to other welfare schemes, which are, pre-elections and the rest of it, then that traction you will see. Otherwise, you've seen today a shift towards institutional sales. That is the large infrastructure, because that is what has really kept the demand going so far. So overall, at a macro level in the industry,
Mr. Ghosh, we understand that and that will be an important shift if it does happen. A couple of key takeaways for us. Number one, you mentioned that pricing has probably made its bottom. You have a very moderate demand growth expectation of 5 to 7%. And now, what is positive for the industry is the fact that there are cost, tailwinds that are pushing in terms of petcoke prices, which have cooled off. So second half of the year, what is the kind of EBITDA per ton realization improvement you can see? And also, in terms of your own incentives, have some of the incentives that you were expecting, has it come through from the government?
I am not going to talk about my company at all, because we are in the silent period. And also, in terms of EBITDA improvement,
For the industry, given the fact that there has been moderation.
So moderation, you've had a EBITDA drop by all estimates, which I'm reading. People are expecting an EBITDA drop in the second quarter. I would, if that gets, if there is recovery from that, then one would look at the last quarter, Q4, optimistically, because that's traditionally a quarter where you have the demand surge, you have the pricing surge, which didn't happen last year for a variety of reasons, elections, etc. This year, if this quarter sort of normalizes, both in terms of you recover the losses in prices, which has happened over the last 3-4 months, as well as the EBITDA drop, which people are putting at an industrial level by what I'm seeing, the analyst estimates all across, they're talking about 150 rupee kind of drop has happened in Q2. If there is, that is made up with some increment of maybe another 50, 100 rupees, then you're there. But word of caution, one doesn't know how the Middle East is playing out. So what you were seeing in petcoke, etc., we'll have to hold our horses there.
Right, got it. All right, very quickly, are you interested in Heidelberg Cement?
we are too small people. Today is a situation when every morning you wake up, you keep hearing about some acquisition happening, but that's more of your market-led, I think. People, you find some companies' prices, share prices shooting up, and the next day, a new candidate, your favorite emerges. We are not into.
I would,
that's very
Sandeepji, appreciate your comment on that. That I think I'll take that as a negative. We're not interested in Heidelberg Cement, but I just want to show you that we are in CNBC-TV18.
I'm not saying interested, disinterested. I'm not in a position to comment. But what I'm saying, I don't get excited personally by every morning there is some new rumor, a new headlines coming. That's today the order of the day in the markets.
Got that, Mr. Sandeep. But I'll tell you what, we are at CNBC-TV18. We only put out verified information. And I think, since you'll be tracking the channel as well, rest assured, when we put out something, we're sure. Till then, in fact, we leave it to reports. Appreciate you joining in. All the best for the second half of the year. And we look forward to having a chat with you at the end of the quarterly results, because then you'll not be in silent period. For the time being, slip in a short break. Come back. We continue to focus on markets.
Welcome back to Chartbusters. As you can see on the top of your screen, it continues to remain a largely lackluster trading session. But the good part of the session is the fact that the broader end of the market, so it's the mid-cap and the small-cap index, that continues to remain in the green. So that's the good part of today's Chartbusters, that the broader end of the markets are doing quite well. But with that, it's a wrap on Chartbusters. Stay tuned. Trading Hour comes up next.